Hey everyone, this is my review of dot.con. It's a book about the dot-com bubble, the internet bubble that happened, starting in the late 1990s and then peaked around the 2000s. Get ready because this summary is going to be quite a long one. I think there was a lot of really interesting things in this book because it gave you a very comprehensive history from the very beginning of how the internet was founded all the way to the tail end of after the dot-com bubble bust. What was the economic fallout? And I think it's really timely in the sense that we're seeing a lot of patterns with the AI bubble. Of course, like I've said before, there's always different flavors to things, so they don't play out exactly history doesn't exactly repeat itself, but there are a lot of big parallels that I kind of highlight in some of my notes. So let's get straight to it, and then, let's go. So one of the most, I think, shocking things in the beginning was understanding the US government was actually responsible for first making the internet, and that this tool was mainly used by a lot of researchers and kind of students at academic institutions in the beginning, and it didn't become widespread until much later on. And the reason was that the US military wanted to create a system for communication that would be resilient against nuclear attack in case, another country tried to wipe out their communication lines and things. So it was really a national defense kind of initial concept, right? And then if we go into kind of a lot of structural factors that led up to this bubble. So this is one thing I took away, is that all bubbles have probably 10 different factors contributing to them. And it's not just the development of the new technology. There are a lot of supporting factors that kind of increase, let's say, the damage done by the bubble. And that's why sometimes some bubbles are worse than others. You can have the Great Depression, the Great Financial Crisis, like you did in the US. But over time, sometimes some of these traits change. For example, the Great Depression was worse because there wasn't a body put in charge of regulating the economy like the Fed chair we have now. So in theory, the Fed chair should be able to kind of reduce the downfall or manage the economic situation such that it crashes much less, or the implications of that are much, smaller on scale. So one of the interesting factors that was more structural, right, was that there's widespread rollout of 401k work retirement investment plans. And this was the catalyst that introduced the average American into the stock and investing world. Because if you think about at this time in the 1990s, early 2000s, there's not a lot of people getting involved with this because it's just something that's been seen as, oh, that's what finance people do for a full-time job. That's what people with a lot of money do. But the average individual doesn't do that. And we can see that today with a lot of democratization of stock trading. And now, although let's say, the rich still own most of the stocks, the people who own any stocks at all is definitely increasing because you can just open up an app on your phone. The fees are pretty minimum and the very low barrier to entry to just start trading now. And so that could be a signal of maybe the bubble now could be worse than other times just because you have everybody participating in it versus just a small group of people. But that's a very subjective thing. And interesting thing too was that there's this widespread idea of diversification for investing and holding long term that was spread widely by mutual fund companies. But why would they spread this by mutual fund companies? The idea was actually to buy more mutual funds. So, I think it's really important to understand that when people give you advice, unfortunately, we would love it for if everyone gave us advice and it was because they loved us and they wanted the best for us. But unfortunately, I think only your family members and your parents are like that. Most other people are looking to kind of take advantage of you in some way, right? And it could be fine if it both benefits you, but sometimes it only benefits them. And I think this mutual fund thing is a good example of that. They'll give you information that you think, oh, this is great information, but it actually funnels you into using their product, and actually they can charge you and then pay for that. So that's one thing to watch out for. One of the really, just to put it on the scale of how crazy the whole bubble was. So there's Wired magazine, right? So the creator of Wired magazine, he was quoted as thinking that the internet's creation was substantial enough to believe that in 20 to 30 years time, we may no longer have a president due to the power of technology. And I think it just shows how easily people become delusional in these times of bubbles. And like, a lot of times you can blame people, but in reality you can't, because when everybody around you is thinking the same thing, this has been studied extensively. There's groupthink, there's a lot of problems with this, and it just destroys any rational thinking. And that's why, like, when the author gets to the end of the book, they realize that, he just talks about this, but everyone realizes how crazy those times actually were. But when you're living through it, you don't think it's crazy. And it's just really shocking and kind of worrisome of how quickly our minds can kind of just be flipped towards, let's say, an AI bubble, or just, towards internet stocks. And that can just grip us. And he was talking about, like, doctors would, in between seeing patients, be trading stocks at that time, or like people just quitting their jobs to try to become full-time day traders. And there are people who are losing tons and tons of money doing that, but people are still trying that, right? Okay, so let's get into like what really propelled the internet forward, because we talk about, okay, like the government kind of created as a research tool, but how does it, interact with normal everyday people? Well, the problem is it's very clunky to access. So I really draw parallels with this in the ChatGPT kind of moment, but pretty much what started off was the creation of the Mosaic browser, and this allowed everyday people to access the internet. So this turned the internet from being a minority kind of thing that people used with less than 1% of people on it to hundreds of thousands of people using it, and this eventually grew to millions and millions. And yeah, so like I said, this could be likened to the ChatGPT moment, because before that moment, AI was definitely readily accessible, at least to researchers and stuff, and people very familiar in those fields. But the average person didn't really know anything about it, and also had no way of actually using it. And ChatGPT really democratized it to anybody who had a website, or had a computer, or could like just log on. They were able to just access it. And so I think this is why you see that really rapid adoption and spread, because now all of a sudden people can use it, and it just requires typing in normal language. You don't need any fancy tools to do that. So they're very interesting overall parallels with the AI bubble, and I'm going to like kind of talk about this a lot, because there is a lot of parallels between the .com boom and the kind of AI boom, right? So early on, Netscape was an early browser that gained traction, but ultimately lost out due to Microsoft entering the internet browser war, right? We can explain why Microsoft was able to win out due to its other business incomes from Microsoft Office that was able to finance such large spending on developing a browser when the revenue model was yet unproven. I think we can make parallels more directly to OpenAI as Netscape and Google as Microsoft, and how Google is able to finance its AI spending with income from Google Ads, YouTube, search, etc., but OpenAI is solely reliant on the AI chatbot style approach to finance development. So this is something we see, and yeah, I just want to bring this up. Often the first companies to bring things to market open the door, but get run over by the companies who are second or third, but have long-term stability due to their other cash flow positive endeavors. Netscape was really the poster child of, it was founded by Mark Andreessen. It was a poster child of the internet boom. But the problem was, it's like, when you create such a thing, it hasn't been proven yet if that model of just providing people access to the internet, especially with the fact that the internet was so cheap, right? In the sense that people expected early on everything just be free, because that was a way for the companies to try to assert market dominance. So their reasoning, which is very similar to people today, right? Their reasoning is just like, oh, if we make everything cheap, more people will use it. And if we have more people in the long run, we'll somehow win. And we see a lot of parallels with this in ChatGPT and just a lot of AI companies, because they're charging $20 a month. Yes, they're charging $200 a month. But in actuality, those costs, even though to the consumer, they seem like a lot. Like $200 a month seems like a lot for just a subscription. But considered how much it actually costs, for example, if you tracked all your usage, because they're pretty much giving you almost unlimited usage. If you actually used up to that limit, you'd be costing them probably like thousands and thousands of dollars, or maybe at least like multiple hundreds of dollars over your subscription. And so this just points to a fact that like the AI subscription model is not profitable, right? They're burning more money to provide you with these things at a lower cost to try to get more people involved in it. And then as such, to actually, kind of logically explain this to investors of why investors need to put more money in this. And we'll see this time and time again with other companies as we go throughout this whole story as it unfolds. But I think it's important to understand that, because like you see that like what happens is like Amazon, for example, gets founded in this time, and everybody thinks it's just a .com bubble company that will eventually burst, and it does burst. But because it had somehow pulled itself together and was able to survive, it actually made it through that period. Same with Microsoft, right? Because Microsoft had the kind of personal computers, Windows aspect, it was able to make it through this period and actually become a very successful company today. So I think an important thing to notice in the potential next, couple years, maybe like like 3 or so years, right, is to see which companies go out of business, but also which companies, again, are able to actually establish a monopoly in these spaces. And if I had to pick some, I would definitely pick probably like Google and maybe Microsoft, right, depending on how their finances are going. But these different, companies have proven revenue models from other sources that are able to finance these big speculative things. But the problem is OpenAI doesn't, NVIDIA kind of doesn't. And that's why there's a lot of potential risk there. Additionally, there was a race of releasing new versions of the browser. So they have like browser 2.0, browser 3.0, all this stuff. And it's just like how we see AI companies releasing new versions of their models and really rushing to do so because they have this idea of, if we have the best model, that will somehow equal to profitability. But I just encourage people to think, and I always encourage people to really think for themselves, right? But it's like, you need to consider at a fundamental level. And I'm telling you, like right now, the business understanding of this is very simple. It's very simple. You just think about how much they're charging, think about how much it costs them to kind of produce whatever product they're making, and then use your just common sense judgment. You don't need a PhD in anything to understand this. It's very basic. Just think, are they making more than they're like spending? And if they are spending more than they're making and they promise somehow they'll make it more in the future, is there a route towards that? I mean, you see like ChatGPT is trying to say, oh, we have ads and things. And that was actually one of the biggest like kind of claims to fame for a lot of these internet browser companies or internet companies in general. They're like, oh, we'll make money on advertisements. But actually in the dot-com bubble, what happened was all these advertisements had terrible click-through rates, which just means people weren't clicking on them. They were looking at them, but they weren't actually clicking on them to buy anything. So therefore they were actually more expensive than traditional means of like putting an ad in the newspaper or those kind of things. And those other means actually had more eyeballs at the time. For example, some magazines had like 2 million buyers a year, right? Versus the internet was still growing very fast, but it hadn't reached that point yet. And people were also not quite comfortable buying things online yet to the degree that it would make sense to charge so much money and actually pay that much money for different companies to advertise on the websites. And this is what we see with kind of ChatGPT. They're trying to introduce ads into it, but there's a recent report that came out that just like ChatGPT ads are not seeing the kind of click-through rates that would justify their kind of success and companies actually like paying them. So there is a big kind of disconnect that we see in both these cases with what people think would be a good revenue model. And it does sound good on paper, but in reality, there's a big difference between that. And that difference then leads to the profitability of this company being largely at risk. And then another important thing to understand is how this company changed over time. So we start at Netscape, right? It starts this whole revolution off. It literally starts off the entire bubble and boom. So I think there's a lot of correlation with how OpenAI started off this whole bubble thing, right? But what happens when Netscape realizes it can't beat Microsoft? So Microsoft does some antitrust kind of regulation breaking where it pretty much uses its monopoly over PCs to integrate its own browser, Internet Explorer, into all the PCs. So for that point, like Netscape's just screwed. Even though what Microsoft did is highly illegal, the judiciary, lawsuits and stuff will take multiple years to play out. And by that time, Netscape will be completely out of business. So this just points out to how powerful having, an incumbent is. And especially when the incumbent decides to actually invest in AI, or let's say in this case, right, you see how much further ahead Google can be with AI, just in the fact that it's so integrated, right? It already has all these other products and now it can use AI to tie them all together. Whereas OpenAI, on the other hand, has the AI as central product, but it has to create all these sub products differently, right? It has to create the codecs. It has to create all the different other parts. So it has to go the different direction. And that's what happened with Netscape, right? Netscape realized it was losing market share. And so it tries to market itself as a software provider for businesses. And this is, strongly paralleling what we see with OpenAI now having a business arm and trying to exploit the B2B side, which is business to business, selling contracting side as well, because like their consumer facing argument isn't nearly as strong anymore. Like I mentioned before, right? Netscape wasn't able to really charge its users anything because people were used to getting most of the stuff for free. And once they charged it, there were going to be other places that were offering stuff for free. Even right now, technically you could use a lot of like AI models completely for free without, you can make an account, use a free account. You can use, so there's still ads. So if you really want to penny pinch, there's also open source models. Like you could use DeepSeek and stuff. So there's so many other alternatives there. And if you are really a stickler about price, then you can just go use those. And all of a sudden, right, there's no reason to use ChatGPT, right? ChatGPT's other models are out there and they're just almost as good, even if they're just like a year old. So like all of this kind of factor has led to the poster child, the person who started it, actually being the one who is the farthest behind. Even though you would think, and this was a big misconception, I think also early in the AI bubble, was like, you have to have first mover advantage, you have to have all this stuff, right? And that's not really the truth, right? It's like actually like the people with sound business fundamentals will last over the long term, right? And I think the most like, I guess kind of crazy thing to me is, I mean, I don't personally know a lot of like, I guess adults like who are much older than me. But I could imagine that there are a lot of those people who are really caught up in the AI bubble. And then for them to have lived through the dot-com bubble, like for me, right, the only way I can learn about this stuff is just reading like this book, right? And it's a very good book, but like that's the only way I can really learn about it. Otherwise, like I wasn't alive during that time. But it just amazed me how people who can live through this kind of event and then have another event happen still fall prey to the same stuff. It's like, okay, the first time you had an excuse. Now the second time, you should be able to take advantage of this. But alas, that doesn't happen because of just, the fundamentals of human nature and how humans work. So let's go on to like the group of people who benefited the most, right? So there's two groups of people who either benefited the most from both these bubbles, right? AI and just internet. Is either the consumers or the investment bankers who finance the IPOs, and these investment bankers will make money regardless if the company succeeds, right? So the consumers in the internet boom era held enormous power, and this resulted in companies not being able to very successfully monetize their service. We see this again with AI in that even though most AI sites are charging money, the amount they are charging is minuscule in comparison to the amount that users can access their powerful and expensive AI tools for. Kind of already talked about this. And then one of the really crazy things I think is just like how accelerated people's timelines were, and the fact that their predictions were not necessarily wrong. They were just like, I would say 20 years too early. So for example, right, so some of the predictions about the internet were spot on, but they were just too early. The e-commerce platforms only developed in the 2010s, which dates itself almost another 10 whole years after the crash. And there was during the internet boom, there's all these different e-commerce companies like Amazon trying to like come up, right? There was different pet companies. They were trying to sell a lot of pet food and deliver. There was different kind of like DoorDash like services that were trying to come, but it's just like, there's a lot of other factors holding things back. And it's like, they're pushing at the edge of innovation, but they're also pushing at the edge of what's currently possible, and that will break. And so that's why those things weren't actually possible at that time, but the predictions were right in the sense they were just off on their timing, that in another 10 years, everything, the market would have matured to the point where these could actually become profitable businesses. And so I think this is something we can see with the AI sphere is like maybe in the initial wave of all these companies, these things won't actually work out. But in the next 10 years following this, we'll have much more solid kind of companies come out of this and be able to do a lot of like very successful things. Yeah, so one of the reasons is this is primarily because we realize the limitations of these technologies and approach their development with more rationality after the bubble bursts, and this allows for more development and more useful things. Just a funny anecdote, many people at the top of the bubble were still saying the market was undervalued. So, I mean, it's just really difficult to, almost impossible to time when exactly the top is, because there was a lot of like false tops and it kept going higher. But I think that it's a certainty that within, bubbles won't last typically more than like 10 years, right? So if you're already X number of years in, you can kind of backtrack. And of course, each bubble is a little bit different, right? Because then you have the crash of 2000, 2001, all the way to 2002, but then you have another crash in 2008, and that's like a housing bubble. So there's no rhyme or reason necessarily. You have to kind of evaluate each one on like its own kind of metrics. One interesting problem, I think, of why the bubble is so big is a lot of fund managers, they had incentives to keep their jobs, and this led them to keep promoting tech stocks, even if they knew it was overvalued, because it's not their money. And if the pop happens, all their peer workers will also lose money, so they won't lose their job through comparison. However, if they take money out of the stock market because they believe it is overvalued, then their returns will be subpar in the short term, leading them likely to get fired since the performance is lower in comparison to others. This makes a lot of sense because if you're in like a firm, right, they want you to keep making as much money as possible. And if you end up losing money, everybody loses money, so it doesn't matter. Right. But if you, let's say, decide, oh, I'm the smart investor, I'm going to pull back, they may be like, why are your returns so low compared to everybody else? It's kind of like a dog eat dog world. I think another very kind of misleading thing is that for IPOs, right, it's initial public offerings. It's when companies go public and they sell a bunch of shares of stock, and then pretty much this is really what happens. They use the retail investors as exit liquidity, and they just sell a bunch of stock at a really high price, and then it crashes as there's more stock flooding the market. So for IPOs, not all the shares of stocks that are used to calculate the estimated net worth of the company are actually traded in the initial periods. Oftentimes, there are nearly 1/8 of the shares available on the open market, as seen in the Amazon case, where only 3 million shares were open for trading, and this resulted in typical supply-demand constraints that artificially produced the price higher. Right. So, for example, if I have I don't know, 2 bananas, and I tell you there's only 2 bananas left in the world, because the supply is so constrained, the demand will be very high, and people will pay a lot of money for it. So same thing here. If I only put 3 million shares out to trade, all of a sudden the demand for Amazon is also going to be very high initially, but because there's only 3 million shares, then everybody's going to bid it up, and that's going to drive the price up really high. And then when they sell those, and then they also add in, let's say, additional shares, the market will be drop much lower because the supply has increased, even though the demand has stayed the same. Yeah, so the problem is these new prices were then used to estimate the value of the company, but in reality, if all the 23 million shares were put out on the market put on the market, the value would be much lower. So, for example, imagine you take a small, how do I say this? Imagine you have let's say you make a bunch of cupcakes, but you pretend you only have 4 cupcakes, and because your stand only has 4 cupcakes, the price for each cupcake is much higher, right? But then what they're doing pretty much is then they're taking that price for each cupcake, because the person buying it thinks, oh, there's only 4 cupcakes, so it's okay if they charge $10 per cupcake, right? But then they're taking that $10 per cupcake, and then let's say you have 40 cupcakes in the back. They're saying, okay, well, if you have 10 times all of the cupcakes together, you're going to get let's say 10 times 50 is 500. That means you're worth 500. Even though if you brought all the cupcakes into the front, the person wouldn't be willing to pay $10 for it. They'd be willing to pay much less because they see there's more, right? And they just know, therefore, each cupcake is not as valuable. That's my best way to explain it. If it doesn't make sense, just put a comment or something. Yeah, so a very similar parallel with the AI bubble is that the internet was very loosely regulated by the government because they believed that it was in the best interest of the nation to allow the internet to grow and develop of its own accord under free market terms. And this is something that we've seen in the AI sense. They don't want to touch it. They want it to just grow on its own. And that can cause a lot of problems, to be honest. Really funny thing is James Cramer, aka Jim Cramer, the guy on Motley Fool, and just he's a meme in investing spheres, because every time he says buy something, they made this index where if you do the exact opposite of what he says, you actually perform really well. So every time he says buy something, people should say oh, you should sell. If he said sell something, it's oh, you should buy. Yeah. But anyway, he got started with promoting stocks during the dot-com bubble, and he was a journalist as well. And so he would write stock recommendations for stocks that he owned tons of, right? And so it's okay, so he's pretty much promoting his own stocks so that they go up, and then he can make more money and then sell them. And it seems like nothing has changed since then either. He's still doing very much the same thing, right? And a lot of his advice is just completely trash. And this is why I think you have to really develop your own mind if you're going to do investing, because it's you can't really follow a lot of these people because their interests and your interests do not align. Okay, and then this is another cool aspect, I think. So even back in the internet bubble, people still had the concept of buying the infrastructure or the companies. So if we think about it, the companies selling the picks in the gold rush, this is the idea that, oh, yes, you could buy the gold in the gold rush, but you could also pay the companies that were making jeans. For example, Levi Strauss, he was making a bunch of jeans, and he made a bunch of money because there's just so many people. And it's oh, this is super stable. This is way better because regardless, there's always going to be a need for people there to have jeans, but you don't know if the gold's going to be there or not anymore after it's all gone. So even in the internet bubble, people had this concept, right? So then this would mean that people invested heavily in any internet tech related stocks that promised to build out the infrastructure of the internet, something we see as very similar to AI's data center capex spending, as well as the focus on NVIDIA as a chip maker fueling the AI boom. Unfortunately, these companies, right, aren't actually immune to stuff, because what happens is the big companies that rely on them, as soon as those companies go under or start having issues, then the demand will decrease as well, and it spreads throughout the whole chain. So there's no real bulletproof part of the chain, to be honest. Another problem that we see now today is we see a lot of companies that have a lot of, let's say, stock-based kind of valuations, or they use stocks to try to pay for other companies. So back in the dot-com bubble, internet companies bought and acquired other companies purely with stock valuations instead of cold hard cash. And we can think about this as a lot of AI revenue on paper, right? And there's a lot of commitments being thrown around, being paid to fund data centers and chips for large AI companies, but there's no actual cold hard cash being put in. There was also a lot of accounting manipulation. So This was done in dot-com era. You have Enron, a lot of other companies, even the big ones were, manipulating accounting stuff. And I'm just telling you, if you understand human nature, you understand why this happens, because all these big CEOs are paid a bunch of money if the stock keeps going up, because their stock options and compensation is tied to the stock value. So of course they're going to find a way to try to like slide, the truth under the table and try to make it seem better than it is. And I guarantee you that we have the same problem today, and that we are currently in a situation where there are probably some like fake records that are out there, and it's just a matter of time before people find them, and before it brings, it's brought to the public light, and that just leads to the companies going pretty much to zero. Like I said before, the dot-com bubble gave birth to the industry and popularity of day trading and spawned tons of camps and seminars about how to make money selling internet stocks. We've seen a lot of poaching of AI scientists recently, right, in the past couple of years. This has some parallels in the dot-com boom, as Webvan, which was an online grocery business, used the allure of potential $100 million packages to hire notable CEOs and executives to help run the company. Nearly all the startups losing immense money were spending it all on advertising, which they tried to argue would increase their market share and eventually lead to profitability. We see a lot of these similar arguments being made today with AI companies. As you see during the Super Bowl ads, they spend exorbitant amount of money on advertisement because the idea is that they will somehow gain market share by being aware to people, but that doesn't necessarily mean that they'll make profit from that. There was a lot of pet-based online companies that were trying to do delivery with goods, and as they battled for market share, they cut rates they were charging. So as I said before, the benefit of all this fighting is really the consumer, because now the consumer is paying prices so cheap that they really shouldn't be getting, but it's because these companies are selling at a huge loss for every delivery. There was a company that actually charged no delivery fee. So it's like you would just buy stuff on the app, and they had a promise of 1 hour delivery time or less, and it's the same exact price as in store. And this was like, you didn't need a membership, you didn't need like a crazy, DoorDash has these weird systems where you have to like pay it money and then you'll get this pass, right? So this is like crazy because it doesn't make sense. And the fact of the matter is, like, it doesn't make sense. So it's like, if you think about it and it doesn't make sense, it probably doesn't make sense. And that's like a red flag. So this is what I'm talking about. It's a lot of just common sense and just not getting stuck in kind of the groupthink. So if we think about the bubble itself, because so much of the bubble momentum is built off of the stock market going up, just as fast as it goes up, the market can reverse and go down. And this is because a high stock market is correlated with a good economy, or at least in people's minds, right? So the average person, they just think, oh, stock market up, we must be doing well. Like, I mean, you can see some like government officials talking about, oh, look at the Dow, it's at like 50,000, right? That's like we're supposed to be really doing well in the economy. But this is not really the truth, okay? This is because So then a high stock market is supposedly correlated with a good economy. It doesn't always happen like that, but this will then lead investors to be encouraged to put their money into the market. So in reality, a high stock market doesn't really always signal a good economy, since inflation feeds the stock market, which is why the S&P 500 goes up year after year. The reason why the stock market keeps going up is because inflation keeps going up and it never goes back down. If inflation kept going back down, right, the stock market would go down. And this is why we see when the Fed increases interest rates, it actually leads to stock market crashes. And when it decreases interest rates, it actually leads to stock market gains. So the fact that there's a high stock market just means there's likely a lot of inflation going on. It doesn't necessarily mean there's a good economy, as we can see with stagflation occurring at the current moment. Okay, some journalists predicted that by 2020, the average income this is during the dot-com bubble, the average income would be 150,000 for everyone, and the Dow Jones Industrial Average would be heading for 100,000. This really reminds me of a lot of claims from people like Elon Musk of having universal basic income and no one needing to work again. There's a lot of complications and issues that get swept under the rug when things are phrased like this, right? When you talk about, oh, everything's gonna be perfect, it's really easy to paint this like picture of everything's gonna be simple, perfect, easy. But in reality, there's a lot of like things that underlie this, and there's a lot of problems with that, right? That people don't consider. So that just highlights how delusional everybody was like kind of thinking, right? Just like how Sam Altman is currently the figurehead for AI, Jeff Bezos was the figurehead for the dot-com boom. I believe in the 1999 Times, he was on the cover for their like edition. So then let's get to the point of when the Fed, which is the federal government reserve, who's in charge of the economy, decides to increase interest rates. What actually happens, right? So even after the Fed had increased interest rates, which usually leads the stock market go down, many investors remained in denial and thought that these increased interest rates wouldn't affect the dot-com companies. So this led the stock market to not plunge as you might anticipate it would. After his rate hike, the Fed chair, Alan I think it was Greensburg or something, was called in by the Senate Banking Committee, and the senators began to roast him for his decision to raise interest rates, saying that they were unnecessary and he was hurting the economy and people without reason. This just shows how delusional everybody was. Because like at this point, the stock market keeps going up. All these companies keep IPOing. They have no revenue. They're losing tons of money, and everybody's just throwing money at them. And it makes no sense, right? It's like if you gave someone $20 and then they came back the next day and said, "Oh, I spent all the $20," and they didn't bring you anything back. Why would you give them more money, right? Like you'd be like, "Oh, here's $40." And they come back the next day and they lose all the $40. They're like, "Oh, here's $60, here's $80, here's $100. Like that makes no absolute sense. And this is exactly what was happening here. They're losing like hundreds of millions of dollars, and companies are just like, sure, that's a good sign. And then like these venture capitalist firms are just giving them more and more money because everybody has a combination of groupthink, herd mentality, FOMO, which is fear of missing out, that just combines into like also with greed. And this just creates the kind of situation for everybody to lose their actual minds. So a revulsion is the term for the instability that occurs at the top of a stock market bubble as people realize this is the top, and some of them begin to cash in on their investments, although obviously not enough of them. And they also take a look at what lies underneath all the media, and this is when the whole story begins to unravel because it's very easy to build it up and just like say, oh, it's going to be fine, let's not think about it, keep going up, 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 up. And then at the top, you start to realize, wait a second, we're standing on a house of cards, and then stuff begins to unravel and go downwards. Another red flag is when companies start issuing convertible bonds because this signals that they aren't able to get enough funds in the traditional ways, like maybe through venture capital or other means. And we actually see some parallels with this today. This happened with Google. So Google was offering 100-year bonds. I think this was at least like maybe a year ago to investors as a way to raise more money. But this also happened during the dot-com bubble. And it's just a really red flag because there's no reason to offer bonds like that. Like that just means there's some sort of problem underlying. Even after the bubble popped, there was a lot of denial from people who strongly expected the market to turn around, and this led to a very gradual decline over time in stock prices. You had people who were saying you should keep buying stocks as stocks went from $30 to like all the way down to $1, and people were saying buy, 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 buy. After the dot-com bubble burst, there was a return to the physical as people began to realize there still existed very real physical constraints on companies, and that by adding the internet, these would not be fixed. My prediction is I think that this will happen soon with AI as people get off of Cloud 9 and return to Earth, realizing the data center CapEx is not sustainable or helpful. So overall, I really like this book. I think it was really good narrative, very helpful. And I just like, I don't know. I think to be successful in life, like it's important to read because by reading, you learn about history, and history is kind of the same blueprint. That's probably what's going to happen, for this AI bubble. And then what's going to happen in like 20 years after that, or what's going to happen after that. There's always going to be something new. But these frameworks, and I think, in my opinion, it cannot be more clear based off of reading this, that the internet bubble and the AI bubble are nearly identical in very many ways, right? You can say, okay, maybe the stock market crash of the 1930s isn't the same. There's some differences there. But I think with the internet and like it being a technology and AI being a technology, and we're being in like a very kind of still 21st century aspect, there's a lot of parallels there. So if you have any other questions, put them in the comments below. Make sure you subscribe for more, and I look forward to more book reviews.